$50 into these three stocks will surpass your full-time job. Apple's quietly becoming one of the most interesting places money's rotating into. And before this video is over, I'm also going to show you two other stocks where that same rotation is happening that most people are completely ignoring. And if you understand the thesis I'm about to lay out, you'll see exactly why these moves are not random, but are instead the logical response to the most significant structural shift in the global economy since the Industrial Revolution. But before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe, because every time you do that, YouTube pushes this video out to more people, and that helps us prepare more people for what's actually happening. The United States is currently carrying more than $38 trillion in debt, and by every historical precedent, the current system should already be under extreme stress and really collapsing at this point. And yet the country continues operating as if nothing is wrong. Financial markets keep hitting all-time highs while the real economy is deteriorating. And the people who are going to come out ahead are the ones who understand not just that something is wrong, but specifically what is wrong and where the opportunities are hiding inside it. So let's get into it. What I want to walk you through today is a piece of financial analysis that circulated over the weekend and moved markets by Monday morning more than almost anything I've seen in years. It was written by a firm called Catrini Research, and it was framed as a macro memo written from the perspective of June 2028, looking back at how the economy arrived at a place where the S&P 500 was down 38% from its October 2026 highs. Unemployment had just printed 10%, and I want to be very clear. This was presented explicitly as a scenario, not a prediction, a thought exercise. And what happens if AI continues doing exactly what everyone is bullish about, but the economic consequences turn out to be the opposite of what the bulls expect? And the reason this piece, I guess, matters for your portfolio right now is not because any of us know whether this specific scenario plays out. It's because the scenario identifies structural vulnerabilities and specific parts of the market that are real right now, today in February 2026. I mean, it's Tuesday at 11 a.m. on the 24th. If you can figure out where capital is going and rotating and why Apple and two other names I'm going to tell you are sitting exactly where that rotation lands, you're in, a good spot. If you're trying to maintain your retirement, trying to maintain a balanced portfolio that can ride through this economic chaos, then I've developed a list of the best 6 stocks to own in 2026 that you can download for free at free.stockscommunity.com. That link's in the description. And if you're actively managing your stock portfolio, head over to stockscommunity.com. I know that link works right now to learn how to buy and sell stocks at the right time. I'm offering a completely free 10-minute training on how I spot stocks before they go up. This is the same training that one of our members watched, and he went on to make thousands of dollars in a day. You can view it 100% free at the link in the description below. And as always, nothing in this video is financial advice. Do your own research. Now, let me explain the core thesis of this Catrini article, because it's generally important and it's not what most people think it is. It's not simply AI doom. It's something more specific and more interesting than that. And it starts with a concept they call ghost GDP, the idea being that as agentic AI tools take a step function jump in capability in late 2025, what happened was companies began discovering that a competent developer working with tools like Claude Code could replicate the core functionality of a mid-market software product in weeks. Not perfectly, not with every edge case handled, but well enough that the CIO, reviewing a $500,000 annual software renewal, started asking, what if we just built this ourselves? And procurement teams began using that possibility as leverage in negotiations. And the long tail of software as a service, SaaS companies like Monday.com, Zapier, Asana began losing pricing power, not because their products stopped working, but because the credible threat of replacement had become real. And the scenario describes a ServiceNow earnings report in Q3 2026, where net new annual contract value growth decelerated sharply. A 15% workforce reduction was announced and shares fell 18%. And what made that print significant was not just the miss, but the mechanism it revealed. ServiceNow sold seats, and when their Fortune 500 clients cut 15% of their workforce, they canceled 15% of their licenses, meaning the AI-driven headcount reductions that were boosting margins at the client companies were mechanically destroying the revenue base of the software companies that served them. And the companies most threatened by AI became AI's most aggressive adopters. Not because they wanted to, but because the alternative was to sit still and die slower. And the collective result of every company making that individually rational decision was that every dollar saved on headcount flowed into AI capability that made the next round of job cuts possible, and the feedback loop had no natural break. Now, here's where it gets, goes from interesting to alarming, because the scenario does not stop at software. It describes what happens when this logic escapes the software sector and begins eating the intermediation layer on this entire economy, meaning every business model built on monetizing human friction. And they go through the examples in detail. Travel booking platforms disrupted because agents can assemble a complete itinerary faster and cheaper than any platform. Insurance renewals disrupted because agents reshop your coverage automatically, and the 15 to 20% of premiums insurers earned from passive renewals inertias just evaporates. Financial advice, tax prep, routine legal work, any category where the service provider's value is ultimately navigating complexity that the customer found tedious. All of it disrupted because the agents find nothing tedious. And real estate, where buyers had tolerated 5 to 6% commissions for decades because of information asymmetry between agent and consumer, crumbled once AI agents equipped with transaction data could replicate that knowledge base instantly. And DoorDash is the poster child for habitual intermediation collapse because their entire moat was built on you're hungry, you're lazy, and this is the app on your home screen. An agent, it doesn't have a home screen. It checks every platform and picks the lowest fee every time. And MasterCard and Visa are under pressure because once agents controlled the transaction, they went looking for cheaper payment rails and began routing around the 2 to 3% interchange rate towards stablecoins, where settlement is near instant and the transaction cost is fractions of a penny. Good sentiment too. And American Express hit the hardest. Combined headwind of white-collar workforce reductions, getting its customer base, and agents routing around interchange, gutting its revenue model. And you can see why the market sold off the way it did when this piece circulated. ServiceNow fell almost 4.5%, MasterCard and Visa dropped. American Express had one of its worst single-day performances in years. IBM fell over 13% after Anthropic announced Claude can streamline COBOL code that powers 95% of US ATM transactions. CrowdStrike fell over 10% after the Claude Code security announcement. And what you're watching in real time is the market beginning to price in the structural vulnerabilities that the Catrini scenario mapped out 2 years in advance of where the scenario actually gets bad. But here's the part of the scenario that I think is the most underappreciated and the most important for understanding where capital needs to go. Because the scenario describes what happens downstream of all this white-collar displacement in the labor market. And it's brutal and specific. Displaced white-collar workers do not sit idle, they downshift. A senior product manager at Salesforce making $180,000 a year loses her job in a round of layoffs, spends 6 months searching, and ends up driving for Uber at $45,000 a year. And the scenario describes multiplying that dynamic by hundreds of thousands of workers across every major metro, overqualified labor flooding the service and gig economy, pushing down wages for existing workers who are already struggling. Sector-specific disruption metastasizing into economy-wide wage compression, and the transmission to the mortgage market is where it becomes truly systemic, because the U.S. residential mortgage market is approximately $13 trillion, and it's built on the assumption that the borrower will remain employed at roughly their current income level for the duration of the loan. And the white-collar employment crisis threatens that assumption in a way that none of the historical mortgage crisis frameworks can adequately model, because in 2008, the mortgage loans were bad on day one. In this scenario, the loans were good on day one, and the world changed after the loans were written. These are 780 FICO score borrowers who put 20% down with clean credit histories and documented incomes, the borrowers that every risk model treats as the bedrock of credit quality. And when those borrowers start drawing down HELOCs, pulling from 401ks, running up credit cards just to maintain current mortgage payments, the early warning signs do not look alarming until suddenly they do. And the scenario describes home prices falling 11% year over year in San Francisco, 9% in Seattle, 8% in Austin, with Fannie Mae flagging elevated early stage delinquencies in zip codes with more than 40% tech and finance employment. And it describes the private credit layer cracking underneath all of it. Zendesk defaulting on a $5 billion direct lending facility as the largest private credit software default on record. Moody's downgrading $18 billion of private equity-backed software debt across 14 issuers. Life insurance companies that have been used as funding vehicles for private credit now facing a regulatory pressure to raise capital or sell assets, and a spiderweb of offshore SPVs and Bermuda reinsurers and PE-owned rating agencies whose opacity makes it genuinely unanswerable in real time who actually bears the loss when the underlying loans default. And all this is what the Fed chair in this scenario calls a daisy chain of correlated bets on white-collar productivity growth. Now, I want to be clear again that the Catrini article, this is a scenario, it's not a prediction, and there are legitimate counter-arguments. Bank of America made the point that you cannot simultaneously believe AI spending is going to collapse and that AI is powerful enough to destroy established software businesses. Those two fears are logically inconsistent. If AI spending collapses, AI does not get powerful enough to make Salesforce irrelevant. And if AI gets powerful enough to make Salesforce relevant, that requires enormous continued investment. And there's also the institutional momentum argument that we consistently underestimate how long disruption actually takes. Real estate brokers, they've been predicted to be obsolete for 20 years, and they're still collecting 5 to 6% commissions because of regulatory capture and market inertia. And the iron rule of institutional change is that everything takes longer and is more complicated than you think it will be. And the number of Americans who work in tech is less than 10% of the total workforce. Software developers, less than 1%. So even massive reallocation in the tech sector does not immediately translate to the kind of broad economic collapse the scenario describes. But here's what I want you to take away from all this, regardless of which version of the future is right. The market is already voting, and the vote is clearly for rotation out of software, payments, and AI-adjacent SaaS into things that are real, tangible, necessary, and not exposed to the disruption loop the Catrini scenario describes. Energy's up 23% year to date, gold and silver up 19 to 20%, materials up 16%, consumer staples up over 14%, utilities and real estate both pushing higher, and the equal-weighted S&P 500, that's RSP, is near all-time highs, while the market cap weighted version lags because the pain is concentrated exactly where the concentration of capital was, in the Magnificent Seven and big tech. And Warren Buffett is sitting on $382 billion in cash at Berkshire, wall-cutting positions in Apple, Amazon, and Bank of America, which tells you that the smartest long-term money in the world sees more risk in this market than the headline numbers suggest. So, what did I miss, and what would you push back on? Let me know in the comments below. And if you're managing your portfolio independently and want to know how I spot stocks before they go up, watch my completely free training at stockscommunity.com, where I go over the same methods I teach my students on how to find the best stocks, spending just 10 minutes in front of their computers a day. And if you already have a portfolio and want to make sure you're in the best stocks in the market, download my best 6 stocks to own in 2026 for free at free.stockscommunity.com. Now, let me, tell me where the specific opportunity is, the sector rotation is. I want to close with this as the part that it ties it all together, right? So Apple first. Here's why Apple is different from the rest of the Mag 7 in this environment. Apple is not primarily a software company in the way that ServiceNow or Salesforce or Microsoft is a software company. Apple is a hardware and ecosystem company. It sells physical devices that people hold in their hands, and it captures recurring revenue through a services layer that's deeply embedded in daily life in a way that's genuinely sticky. And the Catrini scenario actually makes the case for Apple indirectly, because when it describes agents routing around intermediation and disrupting every friction-based business model, it's describing exactly the kind of platform that benefits from owning the device layer. Because whoever owns the device owns the relationship with the agent. And Apple is positioned to be the hardware through which agentic AI operates for hundreds of millions of consumers. And unlike pure software companies, Apple has physical manufacturing scale, a global supply chain, a loyal premium customer base, and a brand that's proven remarkably resistant to disruption over 2 decades. And in a market that is rotating away from pure software and toward things that are tangible and durable, Apple sits at an intersection of both. It's the tech stock It's most defensible in the scenario the Catrini piece describes because its value is not primarily locked in software seats or recurring SaaS contracts that an AI agent can replicate. It's locked in the physical device and the ecosystem around it. And it's trading at a significant discount to where it was at peak Magnificent 7 enthusiasm, which means you're getting one of the most durable consumer technology franchises in history at a price that reflects the broad tech sell-off rather than Apple's specific competitive position. Now, let me talk about the two names that I think represent the clearest expression of where money is rotating in this environment, and both of them are in the automotive sector, General Motors and Ford. And I want to explain exactly why these two companies are sitting in the path of significant capital rotation right now. The core logic is this: the Catrini scenario, whether it plays out exactly as written or not, describes a world where the premium on human white-collar intelligence is declining and where the companies that are most exposed are the ones whose value is built on software, data, and intermediation. And the companies that are least exposed are the ones whose value is built on physical manufacturing, hard assets, and products that the real economy needs regardless of what any AI agent does. And General Motors and Ford are exactly those companies. They make trucks and SUVs that contractors and farmers and logistics companies buy because they need them. They have a massive manufacturing infrastructure in the US that's becoming a more strategically valuable, not less, as tariff uncertainty makes domestic production a competitive advantage rather than a cost burden. And here's the thing about tariffs that the market is missing when it comes to US automakers. The tariff chaos that's hammering tech supply chains and creating uncertainty for companies with complex global manufacturing dependencies is actually a relative tailwind for companies that build a significant portion of their product domestically. And both the GM and Ford have been aggressively repositioning their manufacturing footprints to be more US-centric, which means the 15% global tariff uncertainty that's freezing capital allocation decisions for companies like Apple or NVIDIA is a different story entirely for a company that makes trucks in Michigan and sells them to Americans who need trucks, regardless of what the S&P 500 does. And both stocks have been absolutely beaten down as part of the broad sell-off in consumer discretionary and financials, trading at valuations that price in a recession that's not happened yet and that ignore the specific competitive advantages they carry in this particular macro environment. Low price to earnings multiples, dividend yields that pay you while you wait, domestic manufacturing exposure that's a hedge against the tariff uncertainty dragging on the rest of the market, and a product lineup built on the kind of durable physical demand that does not evaporate because a language model learned to write code. And in a market where the rotation is clearly toward things that are real and tangible and necessary, a truck is about as real and tangible and necessary as it gets, which is why General Motors and Ford are sitting exactly where patient capital lands when the AI disruption narrative forces a genuine rethink of what is defensible and what is not. And if you found this information valuable, smash that like button and subscribe to the channel and share this with somebody who needs to hear it, because the people who prepare themselves, and it's only Tuesday the 24th at 11 a.m., but you're going to stay one step ahead through this week, and the people who do that are going to come out ahead in the long run. So